You know, there are a lot of books on the financial crisis, and from most of the books you can learn important things, such as why Dick Fuld was kicked out of ROTC when he was in college, or what were Ben Bernanke's college board scores. Does anyone know that he had the highest college board scores of any high school student in South Carolina? Without these facts, you cannot fully understand the financial crisis. Now, I tried to take a different approach and try to figure out what should we do about all this. And here is a quote that is usually attributed to Rahm Emanuel, but actually it's from Machiavelli. And for those of you who know Rahm Emanuel, you can know that there is a very close similarity. And Rahm tells us we need, and so did Machiavelli, we need to make sure that this crisis doesn't go to waste. We need to make sure that we learn how to deal with future crises. Now, the predicate of my whole discussion is, you know, how do we reduce the frequency and the severity of financial crisis? So as a predicate, it'd be useful for us to have a sense of how many crises occur. So let me ask you, Joseph, I've done a survey, and most people say that a financial crisis occurs once every 10 years or every 20 years. Would you agree with that? Are you into 30 years, 10 years, 20 years, 5 years, every year? What do you think? More often than once every 10 years. How many people would say more often than once every 10 years? How many people would say once every 10 years? How many people would say once every 20 years? Okay, so let's look at the numbers. Well, as a good professor, we come to a definitional issue. How are we defining financial crisis? And the answer is, if we define it globally to include everything, including sovereign defaults on sovereign debt of Latin American countries, we have on the left Barry Eichengreen's numbers, which show you that there are a huge number of financial crises if you look across the globe and you include every different type of financial crisis. And most importantly, on his methodology, you can see the frequency is going up very quickly. That's probably the most important thing on a consistent methodology. And why? Because of globalization, lower transaction costs, more correlation of markets, et cetera. Now, on the right side, we have Ken Rogoff, my colleague at Harvard, who has a very narrow definition of financial crisis. His definition is you have to have a major banking crisis, not a default of debt, major banking crisis where there is a bailout of the financial institutions by the government, and second of all, only in advanced industrial societies. But even on that narrow definition, you can see he's got 22 major banking crises in that 50-year period, which by higher mathematics is 1 every 2.3 years. So you were right. And if we think about it anecdotally, in the last 11 years, we've had the Asian financial crisis, which reverberated in the U.S. through long-term capital. We've had the dot-com bust, and the third is we've had the current crisis. So I pose to you the question. We generally think of financial markets as stable and then an occasional financial crisis. Maybe stability is the exception rather than the rule. If we actually have 5 to 10 years without a financial crisis, maybe that's the exception. And if you have that view, it changes your whole perspective on managing financial institutions, on investing, and on legislation. So I'm now going to talk about a few different subjects. First, I'll talk about the macro view. Then I'll talk about too big to fail. Third is I'll talk about a few specific issues that are really important that aren't being talked about in the legislative form. And lastly, I'll talk about some legislative issues in Mr. Obama's announcement yesterday. So let's start with the global macro point of view. I think most people would understand that the roots of the financial crisis are in the U.S. current account deficit. The U.S. for years had consumers who spent a huge amount. We imported huge amounts. China exported huge amounts. And as a result, we had lots of dollars being held in China, in Japan, in the Middle East. And, oops. This number here, oh, I thought I had a pointer, but I guess I don't. You can see in 2006, you have current account deficit 6% of GDP. That's huge. In any other country, it would have caused a currency crisis. The only reason it didn't cause a currency crisis in the U.S. is because we are the reserve currency. So, with all these dollars overseas, what happened was Chairman Greenspan kept interest rates very low, and these dollars were yield hungry. They couldn't get it in treasuries. They created demand for mortgage-backed securities, higher yield. So this is what really drove the underlying financial crisis. The current account deficit leading to all these investors overseas who weren't satisfied with the yields in treasuries pushing the demand, which pushed Wall Street, which pushed the mortgage brokers. So if we think about reducing financial crisis in the broadest sense, we'd like to do two things. One is we would like Chinese consumers to spend more, and we'd like U.S. consumers to save more, to change this imbalance. So, how many of you have been to China? So, sir, when you were in China, do you remember whether the healthcare system was any good there? Did people have good health insurance? Was there universal health insurance? You don't know. Who else was in China? Yes, Miss, what do you think? Very few have health care insurance. Most of it's out of pocket. How about retirement? Do they have a good social security system? No, very weak. For a communist country, it's fairly amazing that it has a very weak social net. And the reason I mention this is people say, oh, these Chinese, they just like to save a lot of money. It's sort of like a cultural trait. And this is probably partially correct. They do have big savings rates. But what I'm trying to point out is that it's a rational response to having a very weak social net. If you had no one who was going to take care of you in retirement and you had to pay out of pocket for health care, you would be a good saver too. So if we're going to change that side, China needs to address those two big issues. China is aware of this and is working on this, but I point out this is not something that's going to be changed quickly. Now, let's look at the U.S. side. So first we need to look at savings from a household perspective. And we can see that the U.S. savings rate actually went negative about here. So how can you have a negative savings rate? How can a country have a negative savings rate? Could someone explain that to me? What do you say?
You spend more than you earn.
You spend more than you earn. You've got to borrow. And in 2006 alone, Americans borrowed $300 billion in home equity loans and spent it not on their homes, but on consumer issues. So this was a real low or a high mark, depending on how, in terms of personal savings. But we're now up to about 5% personal savings, and it's my view we'll be there for a while. 5% household savings is roughly $500 billion, so that's a good thing. The question is, what is happening on public side? And we can see that the public dis-savings is outrunning the personal savings. This number here, 1.4 trillion. That was the budget deficit for last year. It's roughly 12% of GDP. To give you a sense of how big that is, since World War II, the second biggest deficit we've had is 6% of GDP.